Today, we're breaking down one of the newest, most talked about ETFs in the semiconductor space, the Yieldmax Semiconductor Portfolio Option Income ETF, ticker CHPY. We'll cover how it's structured, what it actually holds, how a covered call ETF works, how its price behaves, and how it compares to other semiconductor ETFs. CHPY is an actively managed exchange-traded fund designed primarily for income. Its investment objective is to seek current income first and capital appreciation. Second, by investing in a select portfolio of semiconductor company stocks and selling options on those stocks to generate premiums. Unlike traditional broad market ETF products, CHPY isn't so tied to an index like the S&P 500 or a standard semiconductor index. CHPY holds between 15 to 30 semiconductor and semiconductor-related companies. As of the most recent data, its top holdings include Broadcom, AVGO, NVIDIA, NVDA, Micron Technology, MU, Lam Research, LRCX, ACM Research, ACMR, and others in similar semiconductor niches. So while this ETF has a concentrated sector focus, it does diversify across several major players in the semiconductor industry. The way CHPY generates income is by selling call options on some or all of its underlying stock holdings. A covered call means the fund owns or is synthetically exposed to a stock and sells someone else the right to buy it at a set price. The buyer pays a premium, which the ETF keeps as income. This options income is what CHPY distributes, usually weekly, to shareholders. However, because CHPY sells calls, if the underlying stocks surge past the strike price, the ETF won T-benefit from all of that upside. It is effectively capped at the strike price on those contracts. The price of CHPY often behaves differently than traditional growth ETFs. Because the ETF prioritizes cash payouts, its net asset value, NAV, typically declines by the amount of the distribution on the ex-dividend date. That pushes the share price lower even if the underlying stocks rise. This means CHPY may trade in a narrower price range over time. Investors are buying more for the income stream than for price growth. Let's compare CHPY to a classic semiconductor ETF like VanEck Semiconductor ETF, SMH. SMH tracks broad semiconductor performance with low expenses and no options overlay. CHPY trades income potential. Its yield can be much higher, but with limited price upside and higher expenses due to options. For example, you'll typically see CHPY's distribution yield far above SMH's dividend yield. But SMH may outperform CHPY during strong upward markets because it doesn't cap growth. The semiconductor sector continues to be driven by growth trends like AI accelerators, data centers, 5G networking, and automotive chips. Global semiconductor sales are expected to continue rising due to demand for specialized AI processors and edge computing. Analysts forecast continued growth, though with typical cyclical volatility as supply and demand adjust. This environment could help semiconductor-focused ETFs, but it won't eliminate the risks of a high-yield, options-driven product like CHPY, which still faces volatility and potential NAV erosion if distributions exceed real income. Summary: CHPY is a covered call options income ETF focused on semiconductors. It holds actual semiconductor stocks and sells option premiums to create income. Its price behavior differs from growth ETFs due to frequent distributions. Compare it with traditional ETFs like SMH to understand trade-offs between income and growth. If you want high income but understand the risks and sector volatility, CHPY may fit certain income-seeking strategies, but it's not the same as a broad index ETF.